Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Avan Dabash, Nikunj Dalmia would be with us shortly. And for the market yesterday, things got stalled thanks to HDFC Bank and Infosys, right? We managed to snap that 9-session gaining streak. Although we did recover about 130 odd points from the session lows, that was thanks to the contribution that you had from some of the FMCG names, for instance. Marquee names like Nestle, ITC, they all sprung up in trade. You had good performance coming in from AI, and then Reliance as well managed to eke out some gains. So that clearly was reflective on how the index went. We are testing the support level of 17,700. Sure enough, we did let go of that 17,800 print. PSBs have really been on a strong footing. Like I said, it was SBI, which was one of the key movers on the index yesterday. They were up over as an index on a net basis 3% in trade. And yes, what we've been seeing is that the Nifty Bank has been seeing some fresh longs. But I think, Avan, if you were to just stack up how the data went by, it was all Infosys. A contribution of 110 points on a Nifty loss of 120.
Absolutely. That tells you the kind of weightage and the kind of impact as well that we had from the IT heavyweight, and clearly reeling on the back of numbers. But incidentally, Aisha, it wasn't alone, because the entire tech slump is what really seemed to have dragged the index lower. Just take a look as to, yes, the kind of fall that we saw, and that's Infosys contribution. But what happened to some of the other tech heavyweights as well in yesterday's trading session, the kind of delivery volumes as well that we witnessed across the board. So there was TCS as well that bore the brunt of the selling pressure. Not quite as bad as what Infosys witnessed, but of course it was a sectoral fall. You had mid caps as well that would not spare the carnage yesterday. So the likes of an LTI Mindtree, Coforge, Persistent, as well as KPIT, all of those stocks clearly came under acute pressure in yesterday's trade. And incidentally as well, if we were to just map out the kind of data that we've seen when it comes to the valuation picture, a lot of these IT companies have come off from their peak valuations, the likes of TCS, Infosys, for example, now at about 24 times for TCS, Infi Ditto from the peak valuations of about 33, and even when it ranges across the board, the likes of HCL Technologies or Tech Mahindra, for instance, at about 30 times peak valuations. You have it currently trading at about 18 times, KPIT 57 to now about 50. So that's really the picture when it comes to the entire IT basket. But let's also touch upon how the global markets shaped up. You did have, for the most part, Wall Street, which wrapped up yesterday's trading session absolutely flat. A mild positive bias you had. It was clearly a lot of results that came out. You had a lot of those technology names. Yes, of course, yesterday you had Alphabet, which fell quite substantially. There's the reports indicated that Samsung is considering now switching its default search engine to Bing. So a lot of traders clearly reacting to that news. This morning, Asia, for the most part, is looking a little bit tempered, barring the Nikkei, which is up about 0.5% or so. You've also got China's first quarter GDP data that's come out, and that, Aisha, has seemed to beat street expectations.
Oh, yeah, absolutely. ITC, of course, has been a big contributor, Nikunj, but you can't take your eyes off from the kind of erosion that Infosys alone caused on the Nifty with 110 points gone.
Yeah, 100 points plus for the Nifty in terms of an absolute crack. 100 points has only come from one single stock.
Yeah.
So if you take Infosys out of the equation, looks like the market yesterday had no trouble whatsoever. But you cannot do that. Markets have to be always looked in isolation. So is the collateral damage in Infosys big enough to turn the tide of the market? Which is that for a market which was nicely chugging along, will this crack in Infosys turn the tide of the market? I'll stick my neck out and say, I doubt. Because IT's net weightage on the Nifty is about 14%. We've already heard from Infosys, which has a big weightage. TCS is behind us, the price adjustment is done. Wipro and HCL Tech expectations are low, and Tech Mahindra becomes a special situation stock. So in terms of an impact, what you will actually see on the index per se, I doubt that the howler from Infosys will really change the rhythm of the market. But this market is showing signs of new leadership, whether it is ITC, Reliance coming up, L&T holding strong. So I would approach the market with a certain degree of value, certain degree of comfort, and with the assumption that at lower levels you want to be a buyer, and at higher levels, I don't think the levels are that high that you really want to start booking profits. Aisha, there was a time when Infosys would sneeze and the entire market would catch a flu. That is not the situation. Infosys in isolation needs to be looked differently, and so there are two things here. Infosys in isolation needs to be looked differently within the IT space, and IT's impact on the net market per se is getting diluted because the net weightage on the Nifty is not even 20%, and financials have a much higher weightage. That's where numbers are strong. So I would say that what Infosys has done, it surely had an impact on the markets yesterday. That is not the end of the story for the market.
But I'm just wondering, I mean, how much more before you actually start nibbling into IT? And does it even make sense looking at the environment that, we are in currently, wherein growth is going to get challenged for IT? Now, the point that we were debating yesterday, whether it's an Infi-only problem or is it an all IT sector problem? We're yet to see that. Looking at TCS, it seems like as of now, it's an Infi-only problem. I mean, from the peak valuation of 33 on Infosys, we've shrunk to 20, from 35 on TCS to 24 now. So how much more before you even think of buying IT again?
So the way I look at Aisha is that IT is going through a slowdown, and it is going to be very case specific. The impact on TCS is much less than Infosys. Impact on Wipro is something which was visible 2 quarters ago. So it's not that all IT companies will get hit at the same time, but the trend in terms of the linearity, the trend is of contraction. I look at markets slightly differently. I was looking at it in the morning, and I looked at IT valuations pre-COVID and I looked at growth valuations pre-COVID. What was the setup pre-COVID and what is the setup right now? Is the setup for IT worse than what it was pre-COVID? The answer to that is no. Are valuations almost there in terms of the pre-COVID levels? The answer to that is yes. So while the markets are giving an valuation comfort, I would say that in the short term, because of the price adjustment and because of the FI over ownership in some of the IT stocks, IT will underperform. Now, what do you do? If Infosys is down 10%, I think it's too late to sell. But it's too early to buy also because you're not really reaching what could be called as a comfort zone. So another 5-7% lower from here, large cap IT, especially a name like Infosys, becomes definitely attractive. Wipro you want to avoid largely because there is still work in progress. I'm not very sure which way the business trajectory is going to move. Tech Mahindra became the special situation stock, and HCL Tech is, I think, attractively priced even at the current juncture if you want to take a leap of faith for next 12 to 18 months. Worst in terms of the news, I think, is behind us. Infosys, the cat is out of the bag. You know the guidance. TCS, you know that they'll struggle with double digit. Wipro has been struggling. So the news is out. Now it's the price adjustment, which is a function of demand and supply. So 4 to 5%, 5 to 7%, I don't know, but I think IT will settle. If you're buying IT, you have to make an assumption that you're buying a sector which gives you a promise of 8 to 10% growth maximum. It gives you great corporate governance. It's not going to be a great multi-bagger from here. There is no cyclicality in it. But with IT, you're buying good corporate governance, great comfort and stability of 8 to 10% growth.
Yep, and we'll know about HCL Technologies in the next 2 days. The kind of weightage that it has on the Nifty is about 1.5%. But there are also other big numbers along with a slew of mid-caps that will be delivering their earnings later this week. You've got Reliance Industries that has a weightage of about 10%, and then of course ICICI Bank, which comes out with its earnings later on Saturday, and that has a weightage of about 8%. So all in all, this week, looking at the large caps, the total weightage stands at about 19.8%. So a lot of critical numbers as well, Nikunj, to watch out for and map out in the week.
Yeah, when I started my career, we used to use this tagline, only Vimal. And I think that applies for Reliance. Because it's only Reliance this week in terms of the market move. And then you go to ICICI Bank. ICICI Bank, I think numbers are going to be okay. You pretty much know which way the trajectory is moving. Reliance becomes important given that Reliance has been underperforming stock and it has gained traction and it has gained momentum in last couple of days. The Reliance Financial Service listing, that is something which is around the corner. Hopefully, you'll hear something on the result in terms of when the listing of the Reliance Financial shares would move. So in terms of weightage, this is not like a very heavy week for weightage. But in terms of the profile of the stocks, ICICI Bank and Reliance, that's crucial. Why? Because they, in a sense, are the leadership. So ICICI Bank may have lost some shine, but it has been an outperforming banking stock, and Reliance has been an underperforming stock, which has gained some degree of mojo. So this earnings season would be important. typically earnings season will always start with IT, which has been good news in last 2 years. This time the earnings season has started with IT, but the news has not been good. So are we in for a reverse surprise, which is a slow start and a great finish? It may happen because second half is always about cyclicals, metals and PSU banks. The surprise is coming from there, unlike IT and private banks.
Yeah, clearly. Okay, and news in the city, Apple's own stores in India are a reality now. Beyond the hype and what these stores are set to offer, the development must be seen in the context of shifting global supply chains and India's push for manufacturing. In fact, Tim Cook is now highlighting 25 years of association with India, and ahead of the opening today for the public, Cook also met Reliance Industries chairman Mukesh Ambani and his top executives in the city, while of course, Madhuri Dixit as well took to Twitter to share them sharing a vada pav at Swati Snacks, Nikunj.
Yep. Vada pav at Swati Snacks. And I'm wondering, is it the Tardev branch or is it the Nariman Point branch?
Must be the Tardev branch.
Yeah.
I don't know, actually.
Yeah, but still pretty exciting with all those images, and it was nothing short of a party, it seems, as you did have the Apple store open, and it clearly seems like the craze for those Apple products in the country is only increasing day by day. So yeah, that's the first retail store. It's called Apple BKC in the Geo World Mall, and you did have Tim Cook as well, as you can see those visuals on your screen, who arrived in the financial park.
You know, I really hope it's more than just Apple store opening. I think when Tim Cook is here, he's not going to just come and stop at Apple store opening. I mean, this time he means business.
Yeah.
We understand that.
He met Chandra, he met Mukesh Ambani.
He's going to meet the Prime Minister as well.
Today.
Yeah.
No, so yeah, that's like the protocol. You meet industrialists and you meet the Prime Minister. But is there going to be any agreement in terms of going beyond manufacturing of just Apple phones? Could it be iPads? Could it be iPods? Could it be MacBooks? Because Apple, in a sense, post-COVID has been successful in making India as a base for Apple products, and they've started exporting Apple phone out of India. And I think the number runs into some $3.5 billion. Could there be another agreement, another indication from the government that we are ready to welcome you and we are ready to give you all the necessary ingredients which are required for you to scale up beyond just Apple phones? Because we are looking at a different technology, a different complete supply chain. But Tim Cook in India, stores opening in India, him meeting the Prime Minister, and hopefully some indication that Apple is going to extend the manufacturing facility. It just tells you that the renaissance of manufacturing, Indian manufacturing, something which we've been talking about, is real and it is here to stay. I mean, one of the most sophisticated phone in the world is now being made in India.
Yeah. Yep, how cool. That. Well, let's also talk about what you saw in ITC yesterday. The fact that the stock managed to clock an all-time peak. It's now above its 200 DMA. But besides ITC, capital goods also have been on a tear. Let's hear out what Devina Mehra from First Global has to say about pockets of interest and where you can buy into right now.
We have been very positive on industrial and capital goods for now over a year and a half, so from October 2021, and that's been a big performer for us because stocks have doubled and tripled also. And we still remain overweight, though. I mean, we've been booking profits. So last quarter also we cut a bit. This quarter also we cut a bit, but relative to the index, we are still way overweight. So that's a sector that we continue to like. We've done some reshuffling also, moved from something where it looked like the move was over to something else. But that sector still we remain positive.
All right, let's move on and take stock as well of some of the global commentary that has been trickling in overnight. We've got Anisha here to wrap it all up for us. Anisha?
Hi, let me start with the comments coming in from the Fed member, wherein Mr. Barkin is talking about how he's reassured by what he's seeing in the banking sector at this point of time. So not too worried about the, impact of the regional bank contagion spreading across to other U.S. banks as well. So that's the positive coming in. However, as far as inflation is concerned, he wants more evidence that inflation will go back to the target that they have in mind, because for now he's not very reassured or satisfied with the kind of indications that they have seen with respect to inflation. The economy, as per him, is just at the fine level, is operating at a fine level, but they need more confirmation that inflation has ebbed away. So a bit of a hawkish commentary coming in from the Fed member. Meantime, ECB President Christine Lagarde also spoke yesterday. She said that the globe might see a bit more instability as the supply elasticity wanes off, and there could be more multipolarity across the world as well. As far as the US debt is concerned, she said she cannot imagine a scenario wherein US can actually default on its debt, but if it does happen, it will have a very big impact, not only for the US economy, but across the globe as well. So those are the key comments coming in. But she did also talk about how the European Capital Markets Union need to be completed at this point of time. Meantime, as far as the commentary on the equity market is concerned, we have seen a solid rally when it comes to NASDAQ on a YTD basis this year. But JP Morgan's Solonovich believes that this is shaky. The tech rally is overstretched. We are already seeing that the tech stocks are in overbought territory, and he believes that any negative, indication coming in or a mild recession coming in might mean that the stocks will slide by anywhere between 15 to 20%. So a bit of, conscious stance coming in from JP Morgan, calling it overbought and close to all-time high levels. Back to you guys.
Anisha, we'll leave it at that. Interesting perspective coming in from speakers and thinkers across the world. But let's also throw light on what the markets are going to be dealing with today. Let's bring on board Naresh Mirani as well as Kunal Bothra as always. Kunal, Naresh, hi, good morning. Kunal, let me come to you first. Out of the 120-point fall in the index, I think 110 alone was Infosys. What's in store for us today? Could Infi settle down at all?
Good morning, Aisha. So let's hope that the market settles back into a range. I would probably say that the markets were too-paced yesterday. Initial gap down because of the way Infosys behaved, and I would say to a major part even how HDFC and HDFC Bank also behaved, specifically post HDFC Bank results. I think major part of the selling was because of these key large cap names which are underperforming. But then on the other hand, there was very good pickup in terms of individual sectors as well as stocks. For example, the bank Nifty. As such, overall did pretty well for itself. It recovered quite smartly from the intraday lows. At one point was down more than 200 plus points, and to close in positive on a day like yesterday was also quite a commendable recovery for the banking index. And more importantly, many of the financial services names have made a good comeback for themselves. So I would now expect that the markets would now get into a zone where the indices may remain a bit more choppy. 17,800 broadly could be a pivot range for the index, and we may probably swing 200, 300 points from those levels. So I think 17,500 to 18,050 broadly is the range which I'm looking at for the Nifty.
Naresh, hi, morning. Let's get in your take as well, given the kind of hammering that we saw in those tech stocks in yesterday's trading session, what that did on an overall index level. The fact that this morning as well, the SGX Nifty is indicating a muted start. What levels are you tracking?
So overall, yesterday was a day for IT. So say 120, 130 points, the Nifty was down. The whole impact came from the IT sector. If we look at the Nifty IT index, it has hit the same lows as it did in September. And mainly thanks to Infosys. And Infosys has a larger weight in the index given the higher free float. But it's given a fresh breakdown that 1400 mark, which was holding for quite some time, has been taken out. So out here, we'll continue to see this choppiness in terms of results for IT. One stock could be down 10% on results, something could be up 5%. So one has to take a stock-specific call, but has to be more cautious. And like I've been saying, I'll wait for the first 4 or 5 major IT results to go out and then maybe to start looking at a fresh trade here. So Infosys has created that negative impact, which creates a problem in terms of trading these names. So I would wait out for the results to get over and then take a fresh view. On the index, we've continued to roll higher, say 17,800 was 600 to 800 was a zone. It's not been as choppy as one would have expected. Yesterday was a good recovery. Bank Nifty continues to take leadership, but more action is on the stock specific side. So Now I expect a base at 17,500, 600 on the bank nifty. So that is as closer to 17,600 is where you want to buy the dips going forward. And overall, the view is more positive on the broader markets. We'll keep seeing stock-specific action.
Right, okay, let's talk stocks then and move beyond Infosys. Kunal, what's on the list?
So two buy calls. The first one, and I'm focusing more on mid-cap names, Aisha. So two buy calls. The first one is one RBL Bank. The stock looked quite charged up yesterday. In fact, last week as well, I had given a bullish call on RBL Bank because my expectation is that the stock would probably be restarting a very strong uptrend for itself. Suggest a buy. Targets revised on the upside to 170 and stop loss trade to 145 for a fresh trade at current levels. AB Capital is the other stock which has done exceptionally well. Managed to break out of a fresh 52-week high. Crossed above the levels of 162. The manner in which the stock closed yesterday, almost at day's high, in the back of some encouraging volumes, was quite attractive for the stock over the near term. So would suggest a buy in AB Capital, 170 as an immediate target, stop us at 159.
Okay, let's find out what exactly Naresh as well has picked out for the day. Naresh, your trading calls?
So looking at more PSU names, one is the first is a buy on GAIL India. The stock has given a fresh breakout, and if we look at the charts on a dividend adjusted basis, the stock has hit a new all-time high. Now that's a very interesting case because the stock has continued with momentum, took a pause around that 105 area, a classical flag formation and a fresh breakout. Expected to see follow-up over the next two sessions, a stop loss at 106 and a quick target 120. Second is a buy on SBI. The stock has made a strong base around 500 and now 500 to 520. All the news around Adani, that is the time it made a low of 500, retested the same zones and now has started making a recovery. Ideally, it should take out the recent highs of 560 to 570 and then maybe a fresh trend start. So initial target price of 575 and a target price of 575 and a stop loss at 530.
Right. Okay, we'll talk about a lot more stocks in just a bit, but let's throw focus on what the brokerages are saying this morning. And JP Morgan believes that it is a good time to actually buy pharma stocks. Let me take it across to Somit, find out what's the rationale behind this. Somit?
Well, JP Morgan has come out with this positive note on pharma sector, and they have stated out 5 reasons why one should be positive on the sector. Now, the first reason is they're saying that the India portfolio is likely to witness the highest price increase this year. Now, they're expecting a 12% price hike for the NLEM portfolio, which will be highest in this segment, while for the non-NLEM portfolio, they're expecting a price hike of around 10%, which is allowed by the government. Now, if you see in the last couple of years, the margins of these pharma companies were squeezed on the back of pricing pressure seen in the US generic market and also because of higher input cost. And now this is expected to reverse in the coming year because the US generic price erosion has relatively moderated while the input and freight cost have softened, and both these factors should aid the margins of the pharma companies in the current financial year. Now, the fourth reason is that they are seeing opportunistic gains in the US market arising on account of increased drug shortage and supply disruption, which should aid the demand for the Indian pharma companies. And the last reason is the valuations are reasonable. Now, if you see Nifty Pharma Index relative valuation compared to the benchmark is on the lower side, while the sector's earnings is expected to grow at a CAGR of nearly 20% over FY22 to FY25. Now, the two top picks for JP Morgan is Sun Pharma and Cipla. They are bullish on Sun Pharma on the back of solid domestic franchise, continued ramp up in specialty business, reducing generic exposure and reasonable valuations, while they are bullish on Cipla on the back of continued outperformance seen in the Indian market, strong traction seen in one of its key products in the US market, while the risk reward is also favorable after the recent correction according to JP Morgan.
Thanks very much. That's the latest coming in on pharma from the house of JP Morgan. But apart from Infosys yesterday, the other most talked about stock and of course the most memed and trolled stock is ITC. And boy, what a fitting answer it gave to the trolls yesterday. It surpassed the 400 rupee mark, hitting that all-time high, currently trading at those levels, doubling in less than 2 years. So what are the triggers that's driving this optimism? Vinny, my colleague, joins in with all the details. Vinny?
Good morning, and let's talk about ITC's journey, because from the most meme stock, it's become one of the most loved stock, because last 1 year, the stock has more than doubled all-time highs of more than 400 rupees. Currently also standing around that 400 rupees mark is what we're seeing. And what are the positive triggers when you talk about it is, let's not forget what impacts ITC the most is one in terms of the cigarette business, which accounts to most of its revenues. Cigarette business has seen a resilient growth so far. Recovery has been quite good post-COVID as well, and it's expected to continue this resilient growth even in this quarter. Also, the non-FMCG business has FMCG business as well, and non-FMCG business other like hotels and all have also seen a strong growth as well. They've given a steady performance so far in all these businesses as well. Hotel business has seen a very sharp recovery. Even a paperboard business has seen an accelerated growth as well. So these are some of the key triggers that are supporting ITC and could support ITC going forward as well. Stable taxation is a key factor that one watches out for, and every budget you're keeping an eye out on that for ITC. And in the last 5 years, the taxation has remained quite stable. So that is something that is supporting ITC as well. And obviously the curbs on the cigarettes is supporting the cigarette business for the company as well. Do not forget, there was a recent interview which had come in ET where the company had highlighted in terms of the hotel alternate structure is what they would be looking at in the next 2 quarters as well. So that is something important that one is watching out for. What is going to be the change over there as well? And attractive valuations is something we don't need to talk about much, because ITC is much cheaper in terms of FMCG companies compared to other FMCG companies as well. When you talk about some of the risks in terms of slowdown in demand could be a risk. Otherwise, rural demand could be a risk if that continues to be weak. And any changes in government policies are factors that we're keeping an eye out on. In terms of the SOTP valuation, currently the street is giving a valuation of 58% to the cigarette business and 26% to the FMCG business, and other sectors as well, other hotel, paperboard, etc. is in the range of around 4 to 7% that we are seeing coming in. So ITC looking attractive because it's much cheaper in terms of valuations as well.
Right, that is the case coming in on ITC. But beverage major Coca-Cola has acquired a 15% stake in #Loyalty, which operates Thrive, which is a food tech startup. But how will this deal impact, the existing stake of 35% in # that Jubilant FoodWorks has? Vinny, how do you think this is going to work out?
So, just to take a step back, because Jubilant FoodWorks had acquired 35% stake in Thrive, the #Loyalty company, which acquired in 2021. They had acquired the stake for around 24 crores. Now, obviously, in terms just of the disclosure, yesterday we had reports saying that Coca-Cola is buying minority stake in #Loyalty, and that is what came in the disclosure last evening as well, that Coca-Cola bought around 15% stake in #Loyalty, which runs the Thrive business, and the Thrive is a competition to, could be a competition to furthermore in terms of Swiggy as well as Zomato. Yes, we are keeping an eye on that, but this is just a fundraising that has happened by Thrive, and because Jubilant FoodWorks does have stake in this, 35% stake now will be diluted, and it is going to be somewhere around 29% stake is what Jubilant will continue to hold in #Loyalty. Coca-Cola's investment will be interesting to see how this actually helps #Loyalty in terms of moving forward, growing their business even forward more, because Coca-Cola does have deep pockets as well, which they could use in terms of spending as well. So will be interesting to see how this actually moves on, and obviously the benefit that Jubilant FoodWorks will get if Thrive grows bigger going forward.
All right, thanks very much for giving us all of those details. Moving right on then, lots of other stocks and news and affordable housing financiers, they're on Morgan Stanley's radar. The brokerage house has initiated ratings on 4 companies from this basket. Which ones are they? Harsh joins in with the details. Harsh?
Well, yes. So one attractive piece that Morgan Stanley highlights is that the total addressable market for some of these affordable housing finance companies is quite large, and hence the runway for growth is large as well. But outside of that, in terms of risks itself, what could the risk be from banks? What Morgan Stanley seems to highlight is that affordable housing finance companies have, or they deal with a customer cohort which is largely differentiated and which is difficult for banks to really penetrate into, because of one, the lower ticket sizes, and second is that the different types of incomes that some of these customers earn, which are largely also in the informal segment. So it's difficult to assess for banks on a quick and an easy basis, and the lower ticket values also keep banks away from some of these customers, and therefore Morgan Stanley believes that affordable housing finance companies will continue to enjoy the kind of leverage with these customers that they currently do. In terms of asset quality, of course, what also Morgan Stanley also highlights is that through COVID, some of the companies have been able to sustain their asset quality, and now, as COVID is firmly behind us, their asset quality has improved, and therefore it shows a bit of resilience with regard to asset quality as well for some of these companies. In terms of valuations, they believe that valuations have started to become reasonable, and valuations are one standard deviation below the mean, and even in terms of stock performance, some of these stocks have underperformed for the last 12 to 18 months. And given that rates are now pretty much at peak, these valuations suddenly have started to look quite attractive. So they have initiated coverage on 4, Aptus, Avas, Home First, as well as Canfin, and they have given an overweight rating for both Aptus as well as Home First, and an equal weight rating for Avas and Canfin.
Okay, Harsh, we'll leave it at that. In fact, let's slip into a very quick break on that note. Let's just bring up the SGX Nifty. That's indicating a mildly negative start for us. Pretty much flat, you'd have to say, about 30 points lower. We'll take a break, but as we do that, here are Neeraj Devan as to why he's bullish on these two stocks.
Metals, as far as demand is concerned, is picking up. So there are some, initial moves that we saw in some metal names also. In fact, if you look at, besides ferrous metal, you see a non-ferrous or stainless steel. Stainless steel anyway has been doing so well. If you look at the only company listed which is purely in stainless steel, as a Jindal Stainless, have been doing very well, and they're still seeing that demand is very strong. I think even the other non-ferrous names, whether it's Vedanta, so aluminum stocks, zinc, I think they also look very interesting. I think metals this year should do better than what they did last year. I think demand is picking up, and if the demand continues, because China opening up is also aiding to the demand. So if that continues, I think you will see a better performance this year than we saw last year in metals.
All right, let's connect with Pankaj Pandey as well, who's joining in, head research at ICICIdirect.com. Pankaj, so much to chat about, but why don't we first up start by getting your take as to what transpired yesterday in terms of those IT stocks. Infosys clearly bore the brunt of the sell-off, reacting to its numbers, and you did see that ripple effect out on all of the other tech majors. Your view on, given the kind of weightage and impact it had on yesterday's Nifty fall?
So one thing is, US market is still sort of facing a lot of challenges, especially from a growth perspective, and BFSI being the largest vertical for most of your IT firms will continue to sort of face that kind of volatility, especially related to growth. Infosys, particularly, we have downgraded or we have lowered our target to 1600. Now it is trading at about 20% kind of a valuation discount to TCS, largely because the growth differential between the two has sort of spiked up. Our sense is that probably 3 to 6 months down the line, as and when the US growth sort of stabilizes and most of the challenges are behind us, probably if we could sort of improve their guidance going forward, that is what we have since, or that is what we have historically seen also. So from that perspective, I think in next 6 months, besides this kind of a price correction, I think we expect IT to sort of do more of a time correction. But these are good levels to buy, and which is why we have a buy rating on both Infosys and TCS. But near-term price performance, I think we don't expect. So things continue to remain sort of lackluster for IT as an overall pack.
Why is ITC making new highs, Pankaj? 1 year ago, nobody liked it. 2 years ago, everybody disregarded it. FIs are selling and ITC is going higher. They're still in the same business, cigarette, FMCG, agri. They were in the business 2 years ago. Nothing has changed, but the stock has gone from 200 to 400. Kya badla hai bhai?
So Nikunj, on ITC, what we are, our target is about 450. Now, when you sort of look at last 5 years, the taxation has been pretty stable, and that has sort of revived the cigarette volume. So even for this particular quarter, we're expecting cigarette volumes to grow at about 30%. And even the FMCG business is expected to grow in double digits, largely led by food, discretionary and stationery segment. And then hotel as a business is already sort of doing well. So we are expecting good set of numbers for most of the hotel players. Now this stock is trading at about 25, 26 times. When you sort of look at the other FMCG majors, be it HUL or be it Nestle, all of them are trading somewhere in the range of 55 to 60 kind of a forward 2-year multiple, which is quite high. And so from that perspective, I think ITC is sort of relatively benefiting. I think high value or high P multiple names are not really sort of facing the kind of buying, largely because there are a lot of fear in terms of entry of new players, be it FMCG, be it paints. Because once you see entry of new players coming in, either the growth gets chipped off, or the valuation or the margin sort of get capped, or it could be a combination of both. ITC, I think, from that perspective, is relatively better off with valuation being the biggest favor in their favor. So which is why it is helping. And yeah, for ITC, our target price is 450.
This is the right way of looking at ITC valuations. You can't compare with Nestle. The return ratios are different. Their FMCG business is still losing money, or is just about to make money. What is the right valuation for ITC?
So typically, So typically, when you sort of look at cigarette business, see, structurally that growth could be about 4-5% in the cigarette business if the taxation were to sort of normalize, or we don't see fresh bouts of higher taxation. Now, FMCG is something which is valued at 4 to 5 times sales. Typically, all these bigger companies or well-established names are commanding even more higher multiples. And then I think the hotel as a business is something where the bulk of the capital allocation has gone in. And that is where I think has been the biggest pain point. But that business is sort of thriving or reviving for most of the players, including ITC. So I think a combination of all these is sort of helping ITC and leading to better valuations or leading to better price performance compared to the other FMCG companies.
Right, okay, that's the take coming in on ITC. A lot of other stocks as well, which have been in focus. And Pankaj, I mean, it's unfortunate that we're only going to react on next Monday, but Reliance and ICICI Bank, one on Friday and then one on Saturday. What do you anticipate from these two heavyweights in terms of earnings?
So Reliance, overall, our sense is that oil to chemical business would see about 11% kind of a quarter-on-quarter growth last year, because the refining margins have been relatively better compared to last quarter, while the petchem business is expected to remain soft. Nothing much is expected on the geo side, because ARPUs are likely to be at stable or 0.5% kind of an improvement is what you would see. I think the retail business is expected to deliver 20% kind of a growth and with better margins. So our sense is that you will see margins improving by about 70 bips. So overall, Reliance looks a lot better, given the fact that they are sort of playing their cards very well in a number of other business segments. I can't comment on ICICI because I'm part of that same group. So, but within bank, I will like HDFC Bank the most.
Right, okay, that's the take coming in. HDFC Bank, clearly the preferred one as opposed to ICICI Bank. But Kunal, if we were to just stack up the charts within the FMCG pack yesterday, both Nestle, ITC, Britannia, is there a trend that you spot, or do you think it was just a one-off move within the FMCG sector?
No, so as of now, it looks like the markets are getting into a zone where, for example, ITC was one of the stock which was actually doing exceptionally well for itself throughout the last, so many weeks, as well as the last 1.5 odd year. The likes of Nestle, Britannia, I think till end of 2022 or maybe the first month of 2023, these stocks, did pretty well for themselves. But then when the correction started off for these names, the correction panned out to be more than 15 to 20% odd for most of the stocks. In fact, most of the FMCG names, I think just about a month or so back, had come back below their 200 DMAs respectively, and some of them have been even trading below their 200 moving averages. So what we are seeing right now, at least that's what my sense is, that we are seeing more of a very slow and gradual recovery for the FMCG pack as such on an overall basis. But I think the larger part of the trend seems to be more stronger for ITC, because that stock has not gone into any major correction, and on the other hand, that stock has been maintaining its upward trajectory without major bouts of volatility. So ITC is a stock which I think looks attractive even at current levels. But as I said yesterday, that from now on towards a short-term trading time frame, I don't expect too much of an upside. But for someone who has a longer-term time frame with 1.5 or year kind of a time zone, then I think it makes sense to invest into ITC at current levels.
Right, let's speak about that very stock because that's what's on the editor's radar today, ITC, and then of course we'll discuss Tata Chemicals. And I think it's like a booyah to all of those, the memes and everything, because ITC has chugged its way through a lot of factors as well that have contributed, but now sitting pretty at those all-time highs.
Quote Rakesh Junwala or Buffett who always say that markets can remain irrational more than you can remain solvent. That's really been the case for ITC. Now you could ask yourself, is that from a patch of disregard, is there euphoria in the ITC stock? I don't think so. Yes, the stock is at an all-time high. Everybody is now celebrating. Those who own the stock, they're celebrating that we've got a conviction right. I think ITC is a long way to go. For me, there are three things which have changed. Number one, this narrative around ESG, that you into tobacco, you into energy, you into coal, you would not get it's your due because of the ESG compulsions. I think that's over, because the market now is dominated by domestic investors who care about ESG compulsions, but that is not a necessary compulsion for them before they're investing. Second, like Pankaj also pointed out, I think valuations are nowhere close to what could be called as a bubble level. There are a lot of businesses in ITC which are turning around. We think of ITC as cigarette and FMCG, but there's a hotel business. We tend to underestimate that the hotel business has gone through a cyclical upturn. Yeah. And it's in a good space and expanding a lot. So look at Indian Hotels. Why you should not look at ITC hotel business. Paper business, again firing full cylinders. So the 23 valuation of Nestle and 58 times of Nestle and 23 times of ITC, compare growth and compare the cyclicality what it has to offer. I think ITC has a long way to go.
Yeah, and turning attractive on all parameters, softening commodity prices, all of that also working in favor of ITC. Okay, let's move on then and talk about Tata Chemicals. That's the next stock that we're discussing. That's how it wrapped up in yesterday's trading session, and of course the 52-week chart. But you also have Kotak, which is talking about the soda ash prices now being reduced.
This is a bit of a surprise, because when we spoke to the management of Tata Chemical, and if you scan through the last conference call notes, what have they indicated? We are expanding, there is demand, and we are confident that prices will remain firm. The fact that they've cut prices across India, it will have an impact on Tata Chemical and GHCL. Now GHCL, if you look at it, it is a soda ash company. For Tata Chemical also, soda ash has been one of the mainstay. Why are soda ash prices coming down? I think there is a big demand slowdown, which especially is happening in the developed markets. So this is a bit of a bummer for the stock. This, in a sense, is now going to be a big factor why Tata Chemical in the near term will underperform. Tata Chemical, the stock got re-rated. So that was in a good cycle. The battery business was expanding. The linearity also was coming through in some of their other non-core businesses. But the core business, which is where they were confident of growth and high expansion, if that is coming under pressure, it just makes you wonder that are they in for a tough FY24.
That remains to be seen. Okay, there you have it. ITC, Tata Chemicals, Aisha, those are the two stocks that we've singled out on the editor's radar.
Well, yeah, absolutely. Let's talk about what are the other stocks as well outside this list, and let's focus on Indocount's management meet. In fact, one of the brokerages has listed out a slew of key takeaways from in there, and Lisa joins in with the takeaways.
Yes, Indocount management, they met up with BNK Securities and they have provided outlook for this fiscal. Well, they said that FY24 earnings that is expected to benefit from the GHCL integration. Just to remember that the GHCL Billard unit was acquired by Indocount way back in April 2020. And they say that sufficient land is available for expansion as only 50% has been utilized till date. Also, the FY23 utilization that has been quite low at around 50%, but management said that this is going to improve going forward on the back of GHCL unit integration, and they have not provided any quantitative guidance as such. The gross debt is expected to reduce by 300 to 400 crore in FY24. And on their business segments, the domestic segment that remains strong. However, their focus will be on exports as they look to tap the they look to focus on the untapped markets as the China Plus that is expected to gain traction, and also the competitors like Pakistan and Sri Lanka that they are facing economic challenges. So even major UK retailers, they are looking to source from India, and recently Indocount also tied up with Marks and Spencer, which is a UK retailer. So as we can see, that's the word coming in from Indocount management, and they have provided positive outlook for FY24.
Okay, Lisa, we'll leave it at that. That's the takeaway coming in from the Indocount management meet. Couple of other stocks which are going to be in focus. And of course, key on our radar is going to be Infosys, and how much more selling would the stock actually see. But besides that, whether the selling persists in the rest of the IT pack as well. Kunal, what is your sense on the charts of Infi standalone and the rest of the Nifty IT constituents as well, whether they can see any recovery come by?
So, Aisha, the data, so I'll start off with the data in terms of the volumes, because the last 3-4 days, there has been a dramatic change in terms of the approach for the of the market participants for the IT space. Now, till say in the start of the month of April, the IT index was actually going through a bit of a volume reduction. There was some reduction in terms of long unwinding for the IT index, which means the markets were probably anticipating that going into the results. The idea is to go light into the IT results. Last week we saw some change in terms of open interest, where there was short built up, which was actually happening for most of these large cap IT names, specifically the likes of Infosys, and we also witnessed some of the few mid cap IT names which had seen some rise in the open interest built up, which means that the approach had changed from going into long unwinding to then starting to go short into the IT stocks. Now, for the reversal to happen on the upside, we would need a similar change of stance from the volume participants, where we may either see a bout of short covering, where the prices rally up higher significantly for these IT names, and then there is a significant reduction in terms of open interest, or else we may see a gradual build up of long positions. And that would probably take some bit of more time. So my sense is that we are into a zone where there is too much of activity into the IT index, but the volumes still indicate that there is more of skew and bend towards short built up rather than any kind of long formation. So would just keep it on a wait and watch mode. I don't think that's prudent enough to jump into the IT index just because it's fallen some 6-7% yesterday. I would wait out for the index to settle out and then take a call whether to go long into the individual stocks or just to keep it under the radar.
I just want to mark SGX. Where is SGX? And crude. They both are important. Crude, is 85 the new normal for crude? If it is, then how will the dynamism change? But SGX is indicating that we could be in for a very flat kind of an start, which frankly is not bad considering that we've had 9 days of straight line gains, which frankly is just not bad at all. Pankaj, in last 1 year, why a stock like HUL or a Britannia, companies where stocks are expensive, these are FI dominated stocks, these are stocks where margins have been under pressure, they managed to handsomely beat the market. That's HUL for you, 52-week change, 20%. Britannia, 30%. Now the classic wisdom say that expensive stocks should underperform, and they've underperformed. But these are two stocks which are standing tall.
So Nikunj, a couple of things. Last 1 year, we have seen huge amount of volatility related to market outlook and direction. And typically, whenever that happens, you see defensive sort of playing out better. IT couldn't participate largely because of the global uncertainty, which is still sort of persisting. But domestic driven sectors, especially like, for example, FMCG did well. And it's wrong to say that HUL has not witnessed good margins. I mean, margin used to be about 14-15 odd percent a decade back, and now these are about 22% kind of a margin. Even for this particular quarter, we are expecting about overall 13% kind of a growth, largely driven by pricing. While the rural growth has been sort of weakish, but overall, FMCG has definitely benefited from this overall uncertainty prevailing in the market, especially in the last 1 year. But structurally, we are not very positive on this entire sector. Like I highlighted, if you are seeing entry of new players, typically these margins, which has expanded by 800 to 900 bips in the last 1 decade, probably things might you might witness more of a time correction rather than price correction in a stock like HUL. And same is the case with the higher price names. I mean, we have seen a company like Colgate not doing anything because it's fairly operating in a penetrated category and with multiple sort of shrinking to about 40 times or even below. So it has benefited last 1 year, but whether that thing will continue to play out, I have serious doubts on it. And typically, we are not holding most of the high price names in whatever recommendations which we have been giving to clients on individual basis or on a portfolio basis.
I want to go back to textiles as a category, Nuresh. Whether it is Raymond's or whether it is Trend or even CRM. Is there a trend in making in some of the textile stocks? Because Nuresh, frankly, there's one stock which has disappointed all of us is Aditya Birla Fashion Retail. Is it time to ignore that one and move on?
So that's an indication that markets can put you into the wrong place as well. So I was very bullish on ABFRL. The stock did move up from 280s to 350 multiple times, 330, 350. And once it broke 300, 330 levels, the trend has been weak. And now what we are seeing is say different movements across the textile space. So Trent has been showing a lot of strength, but we are not seeing a similar trend, say in a Shopper Stop or say another name Arvind Fashion. But Trent is doing well. Then in the same case, if you look at Raymond, which is a mix of textiles and real estate, that is doing. But the most important one which I look out for is the most participated one by the domestic institutions, which is KPR Mills. Now that's a stock which is trying to make a 1-year high. So that's come up on the radar. We've seen a smaller name, but an important one, Arvind Limited, move up 10% to 15% over the last few sessions. The next one is Vardhaman Textiles, which is generally a first indication of a trend change. That has yet not come up. So KPR Mills is the one which has come up on the radar. That is a stock coming closer to a 1-year high. But apart from that, there are varied movements across the whole sector. So you have something like a Wellspun India jump up one day, a Arvind jump up one day, but there is no clear trend. So I would be watching it out because it's gone through a good enough consolidation and correction, this sector. So KPR Mills would be the top pick. Next would be watching out for Vardhaman Textiles.
Right. Okay. Those are some stock ideas coming in from within the textile space. Couple of other stocks which are going to be in focus today, and let's just bring out that list for you. This Jubilant FoodWorks. Remember, Vinny just highlighted that Coca-Cola India is acquiring a 15% stake in its arm, #loyalty, for about 104 crore rupees. It's really a minuscule acquisition in terms of, what Coca-Cola's other subsidiaries globally would acquire, or even for that matter with regards to the India business as well. It's very small. But yes, Jubilant also has a stake in that, in #loyalty, that is. So that's another, stock which is going to be in focus. This BEML as well. The equity shares of BEML Land, remember, are going to be listed come April 19th. So that's another stock which is going to be in focus. This announcement came by just last evening. And Z, wherein Oppenheimer has sold about almost 5 crore shares. That equates to about 5.65% stake at a price level of 204 rupees per share via block deals in Z yesterday. That stock was a rank underperformer. Look out for what Z does right now in trade. There's JustDial. We're going to be talking to the management as well in the due course of the show. The revenues have come in higher by a good 39.5%. Margins at a 2-year high, that of nearly 14.5%. This is a bit of that turnaround case. JustDial is what I'm talking about. That stock will just come up for you on your screens. And then Angel One as well, wherein the Q4 EBITDA has come in higher by 20%. Margins have expanded about 400 basis points on a year-on-year basis. So these are a bunch of stocks which are going to be in focus in today's trading session. Naresh, if we could just stack up what really is happening within the auto space, for instance. You've been betting big on the likes of Tata Motors, M&M, TVS Motors, etc. But if you really had to, make a fresh bet on one stock, which one would you pick out from autos?
So that would be Tata Motors, because that is the one which has gone through a good enough consolidation of the last year and a half almost. And the stock has finally broken out after multiple attempts. And more importantly, it made a very strong bottom around that 380 to 400 mark. There were 8 attempts almost over the last 1 year. Multiple bad news there would be on the stock, and it would just not break 380, 400. So that was an indication that the stock is not ready to fall beyond a point. Now we saw a big gap up move one of the days, and over the next 4 sessions also, we just had a fade off for 1 day, and we are back closer to the highs of that session. So overall, a clear-cut breakout here. And we are seeing a leadership change in the auto space. So it was Mahindra and Mahindra, which we rode really well. And now it seems to be Tata Motors. Bajaj Auto has hit a new 52-week high, a strong momentum. TVS Motors has continued on the trend. So overall, and the Nifty Auto Index has also come back, retested the last breakout levels, breached it a little bit, and we've seen a strong recovery. So overall, autos are back on the radar. Auto ancillaries have done well in the near term as well. So Tata Motors is the stock which could surprise on the upside.
Let's get a move on then and focus in on the India strategy on equities that JP Morgan has come out with. They said that they prefer staples and two-wheelers. What's the rationale? Let's take it across to Somit, who has all the details and findings of the report. Somit?
Well, JP Morgan in its report is saying that the consumer demand has been relatively weak, and this was hurt by the rising prices and a poor jobs data. But now both these factors are turning favorable, and on the back of this, they are advising investors to prefer consumer staples and two-wheelers auto. Now they have divided the consumption basket into 4 categories. Firstly is the consumption staples, where they're saying that they were seeing poor volume outcomes on that front. When it comes to autos, especially two-wheelers, the volumes were just below or had just the pre-pandemic levels currently. And then it comes to mass discretionary categories such as apparels, durables and footwear, and then there is higher end discretionary categories such as jewelry. Now the last segment, that is the high end discretionary, that is not exposed to the consumer confidence, the stocks in mass discretionary category, now they have corrected a bit from their peak, but the valuations continue to remain at elevated levels, and thus it leaves us with only 2 segments, that is consumer staples and two-wheelers. And both these segments, according to JP Morgan, can benefit from better demand and valuations which are below or at par with their recent averages. Now they're also saying that poor monsoon is a threat to rural incomes, but this should be compensated by the policy support that could come in from the government side. Now in staple side, they're preferring ITC, HUL, Godavari Consumer, and when it comes to two-wheelers, they are preferring TVS and Bajaj Auto. And they are also saying that it's still premature to buy any mid-cap or low-end discretionary stocks, so they are advising investors to stick to large cap companies like the ITC, HUL, Godavari Consumer, TVS and Bajaj Auto.
Okay, thanks very much. That's the latest strategy coming in from JP Morgan, some of the stocks as well that they like, and that's on their radar. Meantime, Naresh, wanted to get in your take then as to what the outlook is when it comes to some of the stocks within the entire media basket. Z Entertainment, for instance, is in the spotlight. You've also got the likes of PVR, Inox that have been in focus. Results as well will be coming out. Sun TV will be closely eyed on the back of this. What's the expectation from the media space?
So the whole sector has been a washout over the last year or so, or maybe more. We are not seeing a clean trend in any of the names. The stocks which I would be watching out for is Z, because there has been a big block deal yesterday. One of the shareholders, which was the largest holder, has gone out. And now the stock is back to the same price where it all started from. It started from that 180, 200, went up to 350, 380. And we are back towards that same 200 mark today. Whenever that crosses 220, that would indicate a trend change. We are not seeing much of price action anywhere. So Sun TV has been around that same prices of 400 to 450. And 400 was the price in last April as well. And if you go back to, say, April of 2020, it was at the same prices. So the stock has gone nowhere for the last 3 years, whereas the whole market has done well. So it's been a sector which has been a washout. But for now, when a sector which has done so bad for so long, it just remains on radar. But if the price action comes back, so Z, if it crosses 220, that is the time I would start looking at the sector. Till then, it's still an avoid.
Okay, there you have it. That's the view coming in on the media space. And by and large, the street is expecting that it could be a bit of a muted set of earnings this time around. Pankaj, let's understand your some recommendations, some top mid-cap bets.
So some of the names which we are liking is, one of them is Kajaria, with a target price of 1310. One is we expect the gas prices to be softer, See, the margin profile for this company had come down to about 12%. Typically, the margin profile is in the range of 14 to 16%. We would expect those margin profile to sort of get attained in FY24. And on top of it, we are expecting about good low double-digit kind of growth in volumes. So that is one stock which we feel that the margin recovery would be the key theme to sort of watch out for. Another stock is Mayur Uniquoters. Why we like this stock is that the management is very confident of growing from, say, 800 crore kind of a turnover to 1,000 odd crore next year and probably 1,100, 1,200 crore year after. It's a play on the leather segment, especially used in autos, where they derive 55% of the revenues, and the balance is coming from the footwear as a segment. So this is another company which we have been liking with a target price of 5. And then we like some of the names like, say, in the hospitals also, because hospitals, when you sort of look at the deals which is happening, those are happening at 10 times EV by EBITDA, whereas a company like Shalby with a target price of 180, which is what we have put in, is trading at about 10 times EV by EBITDA. And they are sort of venturing into other specialities also besides the knee, where they have got about 15% kind of a market share. And typically, hospital as a space is looking structurally a lot more positive. So this is another company which we have been liking. And then we also like some of the infra names because our sense is that since we are sort of heading into election year, probably we might see elevated levels of spending. So the road players like HEG Infra or something like infra companies like NCC or PSP look attractive to us besides some of the cement companies.
A lot of names. One name in the mid-cap space where someone says, I've got appetite to only buy one stock.
So that will be Mayur Uniquoters.
And if it is two?
Then it will be Kajaria, I'll sort of add to it.
Okay, Kajaria and Mayur Uniquoters. Mayur Uniquoters, I mean, just to introduce this one to our viewers, it's an auto ancillary company. And the more cars will sell, the more car seats will sell. And the more car seats will sell, the more it will really benefit a company like Mayur Uniquoter. But Pankaj, in the past, there have been this family dispute issues for Mayur Uniquoter, right? Son versus father, father versus son. Or is that all behind? I mean, I don't track this one actively. I'm just jogging my memory here.
Yes, I think all that promoter-led selling is behind us. That is what the confidence which we have got from the company. And so besides the improvement, what you see in the domestic autos and also the leather as a segment, I think there 15% of the revenues is expected to come from global OEMs. And that is one segment which is a high margin segment for them. And that is one segment which can grow 2x, 3x over the next 2-3 years. So I think a combination of all this is making us very bullish on the stock.
Right, let's get those mid-cap recommendations going as well. Right now, the pre-open rate's around the 17,790 mark. Naresh, let's find out what's on your radar today.
So, continue to like hotel sector as a whole. That's a sector which did not correct over the last few weeks and now is setting up for a breakout. So I'll go with the largest name, which is Indian Hotels. The stock has broken out about 330. Just not seen a follow-up price action about that. A few months of high being taken out, a good breakout here. I would expect to eventually break out into a new all-time high. A target price of 370 plus and a stop loss at 320.
You have it, Indian Hotels continuing to bet that pick. And Naresh, Kunal, your top bet from the mid-caps?
Well, that would be a buy on Poonawalla FinCorp. Again, making a very strong comeback, coming back above the 300 mark, close slightly above the 300 levels. Very attractive chart patterns because on the daily time frame, the stock has formed a classical inverted head and shoulder pattern for itself. And that, I believe, is a very strong indication that the near-term trends have improved significantly for Poonawalla FinCorp. That's a buy, 320 as a target, stop loss at 290.
Shifting focus in a couple of stocks then, Bombay Dyeing and Kaya. My colleague Sharad is joining us with what is the buzz in some of these stocks in our segment. Kya khabar hai?
Well, yes, important development coming in as compared to the shareholding pattern changes for the month of March itself. Up first, we are having Bombay Dyeing, and over here, Madhuri Madhusudan Kela's name has come up with almost 1.65% stake in the company. company for the month of March itself. Now do remember this entity is promoted by ace investor Madhusudan Kela, and apart from this, now let's look at the key triggers which will actually aid the company in its growth going ahead. And of course, one of the main points is Rahul Anand, who is the CEO of the realty business, is expected to do a turnaround when it comes to realty deals and also in deleveraging of the company. Now do remember, he has a strong pedigree and held leadership positions in the Brookfield Group. Now going ahead, the company itself has large land parcels in the Mumbai metropolitan region, and that itself is expected to be sold in the market values and expected to deleverage the overall balance sheet. And do remember, it's a holding company. Now the second stock which would be in focus, it's a small cap company which is Kaya, but Porinju Veliath has actually increased his stake, on a sequentially basis by almost 60 basis points to coming in at almost 3% stake in the company. Now there are key triggers also for the company, and of course their expansion, especially in the Gulf region, that is something to be in focus on. And also there has been acquisitions coming in the non-Gulf region as well. Apart from this, the company is also focusing on the high margin nutraceutical business.
Much. That's a khabar there on D Street. But let's move on. And Pankaj, thank you so much for taking time out and joining in. Let's run you through all of the other top headlines then that we're mapping out outside of the business world. And yes, few moments away, that historic Apple Store launch in Mumbai itself at BKC. From the ground floor to the first floor, it's a 20,000 square foot Apple Store. And we also know that people have already started queuing up in front of the store from the morning, hoping to get their hands on some pretty cool Apple merchandise. Moving on then, China's first quarter GDP has zoomed 4.5% amid the global peers facing a slowdown. So this really marks the highest growth since the first quarter of last year, when the economy grew by 4.8%. Sequentially, China has seen a growth of 2.2%. Meanwhile, financial services giant Ernst & Young, or now known as EY, has announced that they're going to cut as many as 3,000 jobs in the US, citing overcapacity in the firm. This job cut could impact 5% of the US workforce, and this announcement has promised a comprehensive support to all those who have been affected. And Elon Musk's SpaceX, that was set to launch its towering Starship rocket for the first time from a private facility in Texas, called it off just minutes before the launch. They announced a scrub postponing the launch for at least 48 hours. Not just that, Elon Musk has also announced his intention to introduce an AI platform, Truth GPT, to compete against the current offerings from Microsoft and Google. He's further criticized the Microsoft-backed OpenAI, which is a firm behind the sensation ChatGPT, for training the AI to lie. And IMD back home has flagged off heat wave warnings in several states like Punjab, Haryana, West Bengal, Odisha, etc. Temperatures there are in the range of 40 to 42 degrees Celsius in many parts of the plains of northern West India, adjoining Madhya Pradesh and eastern India. There's also an orange alert that has been issued for West Bengal as it reels under the impact of a heat wave for the last 4 straight days. And India's top court has set to commence same-sex marriage hearings today. The Supreme Court has notified that a 5-judge bench is scheduled to hear the pleas starting today. The petitions that seek legal validation for same-sex marriages in the country are going to be heard. Remember, the centre had opposed these petitions and called them urban elitist, citing that it was very removed from the social ethos of India. Moving on, the Prime Minister is set to inaugurate the 2-day Global Buddhist Summit, which is in the national capital later this week. It'll see the participation of monks, scholars and delegates from across the globe.
Okay, let's tell you what the index strategy is, considering it seems like it's going to be a little bit of a comfort, at least to start off trade with, going by the pre-open rates. A buy on dips coming in from Naresh Mirani, a hold from Kushbora, and a buy on the Nifty from Kunal Bothra. So pretty much tilting towards a consensus there, at least when it comes to the Nifty. What about the Nifty Bank? Because that really has been bifurcated. So no trade from Naresh. He's saying don't trade the Nifty Bank at all. Hold from Kushbora and book profits from Kunal. That's quite an interesting thing coming in.
Sometimes when you have a non-consensus view, that always is a good idea. Why? Because consensus view always is dangerous, whether it's on the upside or always on the downside. My limited point here is that are we in what kind of earning season we are in? I think we are off to a very differentiated earning season this time. Normally the earning season would start with private banks and IT. That's been the hallmark for 2021 and 22. And IT and private banks have delivered. Now IT and private banks may not deliver, but industrials, metals and PSU banks may deliver. So you are in for a slow start and a strong finish, unlike historical earnings seasons where you off to a good start and then a slow finish. Reliance comes in right in the middle, where frankly we've not had a good number surprise coming from Reliance. And are we in for that quarter where excitement around Jio Financial Services, excitement around what is happening on the retail front? Are these two good enough factors to really kickstart a renewed momentum vigor in Reliance? But I want to go back to Infosys. That graphic I think is self-explanatory. Nifty down over 100 points yesterday. Infosys impact. How have we calculated that? Infosys weightage, and you multiply that with the net stock fall, you get the net Nifty impact in points. That data will just come up on your screen. So the Nifty impact and the Infosys impact on the market yesterday was the sole reason why we saw a triple-digit decline. Naresh, the point we got to ask is that is yesterday's market action more like a ripple, or it could change the course of this uptrend?
So I would say not a major impact. Yesterday's move is purely on the IT sector, and IT sector as a whole has gone through a sideways consolidation. The whole outperformance with the Nifty is over. Say it had a huge outperformance in 2021, and over the years, if you look at the last decade or so, IT as a sector has been a market performer. Apart from 2021, which was an aberration in that sense, it has always been a market performer or underperformer. So I think the outperformance is over. We are now, the returns of Nifty IT is equal to or lower than Nifty 50. So in this case, I would not expect a major breakdown as such. There would be stock specific bottoming out over the next few weeks once the results are done with. So at 1150, 1200, I don't think we could go below that on Infosys, and slowly a bounce back towards 1400. But a lot of sideways action could continue. So for now, time to be more stock specific because the broader markets still have a lot of room to go. And more importantly, global markets are in a very different trend. So if you look at a CAC or a FTSE or a DAX, they're a few percentage points away or at a new 52-week high. Even a Nikkei has come to a 6-month high. Yesterday, Shanghai made a breakout. It was a 10-month high. So overall, the global participation is also strong. So that is a good push for Indian markets as well. So overall, time to be more stock specific. A buy on dips on Nifty. Overall, the trend is still very positive.
Kunal, it's literally a climb or gaining higher altitude. That's Interglobe Aviation, which yesterday closed above the 200 DMA. It's interesting, Kunal, that Interglobe Aviation is going up when crude is also going up.
Yeah, Nikunj, I think many of the correlations have sort of been broken over the last many days. We've seen that most of the crude sensitive stocks, for example, Asian Paints did exceptionally well in periods where crude actually underperformed. So I think in that zone, the correlation seems to have broken. But I would be bullish on Interglobe Aviation. Yesterday was a good out about the 1930 mark and also the 200 moving average.
Naresh, is Indigo back on the radar? It's coming out after a big hibernation.
So the only reason it is not on the radar is the constant supply from the promoters, which keeps coming in. So that's a risk which is there for a long time to come. So that's a stock I don't want to trade because the trend picks up and suddenly you have a block and the stock is down 5-10%. So still an avoid, would only be looking at it once the whole supply is over.
First rates, and the first rates are, it's a rub of green for the Nifty. So we lost 100 points yesterday. We've regained a quarter of that. Breadth is looking phenomenal. The IT index, it's going to limp back, it's going to crawl back, but it's a rub of green nevertheless. I can see some, block deals suddenly. There is something in quick heal technology. Not sure why, but yeah, I can see a block deal there. I see some volume action also picking up in names like Bank of Baroda. I can see that there is a solid price action which is visible in BHEL. You got Precision Crankshaft, a stock where Vijay Kedia I think has increased his stake there. TVAT numbers, they continue to disappoint. The stocks now really at the lower end of the bracket, so to speak, at 29-30 rupees. You got Bank of Maharashtra, which is looking okay, but Infosys, that's where the puck essentially moved yesterday, and it's a rub of green for Infosys. But 7 rupees after a 10% decline is more like a cat bounce or a dinky move. I will not read too much into it. But Reliance is holding nice and steady. Angel One is holding nice and steady. JustDial post numbers is holding nice and steady. The market is showing signs of a comeback. And there you go, Tata Motors now jumping all the way up to 475.
Yeah, those are a couple of stocks which are active in trade. Let's see what Infosys is up to, what an HDFC Bank is doing, where these stocks have settled in. Some of the other IT majors though are seeing some respite come in. HDFC Bank flat, marginal green for Infosys, for Tech Mahindra, for HCL Technologies. So it's a bit of a relief. At least they've managed to stall the fall. What are Nestle, SBI, ITC up to, considering they were the ones which really pulled up the Nifty from those session lows? The traction on some of these FMCG names surely continues. Let's see what ITC is doing after making it to that 400 rupee per share mark. ITC 398 is where that stock is, just marginally soft as we speak right now. Bunch of other names which are going to be in focus. Hathway Cable, the EBITDA margins have plunged 32%. Quick Heal, the revenues are lower by 52.5%. There is 361 as well, wherein just yesterday FIH Mauritius Investments sold about nearly 50 lakh shares in a block deal. TV18 Broadcast Nikon just highlighted. The numbers are extremely poor. Tata Chemical, the company has cut light and dense soda ash prices by 3 to 4% across the country. Tata Chemicals as well, gaps down about 3% as we speak right now. Poonawalla FinCorp, this has been very actively traded off late, and a couple of block deals as well. And we told you first at TT Now that Sanjay Chamblia has actually sold about nearly 1% stake at a price point of 290 thereabouts, 0.5% higher for Poonawalla FinCorp. Jubilant FoodWorks, Coca-Cola India has acquired that 15% stake in its arm, #loyalty. Now the correlation here is that Jubilant had acquired, remember, 35% stake in #loyalty in about 2021. Z, Oppenheimer has sold about 5 crore shares. There's JustDial, the revenues have come in solid with an uptick of 39.5%, and Angel One numbers as well are looking pretty strong. JustDial has gapped up 6%, Angel One as well holding up nearly 5% as we speak right now. Kunal, at least we managed to stall the fall from yesterday, but can we build on to gains? Can we inch up and close firmly above 17,800?
I think, Aisha, it's a good start, and I would say even yesterday was a decent day for the markets because most of the selling was on the back of Infi. But I think devoid of that, there were very good stock-specific recoveries which we'd seen yesterday. The market breadth was also very strong. Today also it's very, very similar in terms of the overall market view. So would be bullish on the indices and have a bullish stance on the Nifty specifically, because that's an index which is relatively underperformed. Now the stock which I would look to trade in the open and would recommend would be AB Capital. I think it's a very interesting chart in the making. Already trading at a fresh 52-week high for itself, breaking past about the 160 mark. Looks extremely attractive on the charts and would be bullish on this name.
Right. Naresh, what about your first trades?
So continuing to stick with GAIL, that's a stock which looks interesting. The stock has hit a new GAIL and Indian Hotels. So GAIL is something which has hit a new 52-week high on a dividend adjusted basis. Hotels as the sector looks well. Indian Hotels will be the next one, which could break out in the near term.